Sehr geehrte Damen und Herren, dear sirs and madams, I'm very happy to be here today. I want to talk about challenges, I want to talk about risks as well, but maybe in a slightly different context than you have heard about the last 2 days. At least I hope so, and maybe even with a slightly different outlook into the future. So recently, as you have heard about in the last 2 days, we do not face a financial crisis as in 2007 and 2008. But what we see is change that is about to happen, and maybe even on a similar amplitude that we have seen in the last 10 years, but for different reasons. The problem or the challenge is that it is not clear what exactly needs to be done, and because this change is more endemically for financial players rather than coming from external forces only, the path seems unclear and is indeed a challenge. Today, I'd like to elaborate and sketch a potential path going forward, especially in the context of regulation here in the European Union and in the Eurozone. Maybe not for each institution or every player that is applicable, but for the European or the EU financial markets and especially for the capital markets going forward. But let's start with a short recap on the situation first. As said, Europe faces many challenges which overlay each other and which have unclear or uncertain results. The completion of the regulatory agenda started after the financial crisis on G20 level. In Europe, mainly the implementation of the so-called Basel III and now, however you may call it, Basel IV measures, finalization and stabilization of MiFID II, the CRR2 initiative, EMIR revisions, but as well things with minor interest in the markets, but also quite some effects, like the CSD regulation, which has gone basically unnoticed, but will change collateral flows quite dramatically in the future with its settlement discipline regime. The completion of structural reform measures after the financial crisis coming from the Bank Recovery and Resolution Directive and its national transpositions, especially targeted at the reduction of impediments to resolution as well as enhancing self-sustained resolver or recoverability. And further integration of financial markets by progressing the EU Capital Markets Union to develop a level playing field on the market side. At the same time, those challenges are currently very much amplified by external developments, namely, very prominently, Brexit, which will lead to a fragmentation of capital markets liquidity pools and increased costs for players in the market, consumers as well as corporates, especially on day one. Simultaneously, a tendency of reducing international interconnectedness and focusing on local national benefits first rather than improving the whole system can be observed all over the globe. Especially on the other side of the Atlantic Ocean, a time of slowly but agreed regulatory softening seems to be started and executed. And lastly, a willingness to base the business, at least temporarily, massively on so-called third country exemptions by non-EU headquartered banks to preserve relative cost advantages and synergies compared to EU headquartered banks. Both challenges interacting could lead to a concerning outcome for Europe, meaning the EU and the Eurozone in particular. Brexit revealed the exposure to which the EU and the Eurozone specifically is dependent on one member or maybe a few only, which will become a third country like any other in the future. One could call this even an over-reliance. This puts the ability of the EU and Eurozone, should there be no counteraction, at risk to A, support its real economy and currency in international capital markets and trade flows, and B, can lead to the situation that EU supervisors and policymakers might be exposed to pressure to agree to unwanted actions just to secure short-term access of the EU economies to international capital and hedging markets. At the same time, due to the current third country exemptions, it may be just beneficial for banks, especially internationally operating banks, not to operate out of the EU, but to offer services cross-border out of third countries. This leads to a structural disadvantage of EU headquartered banks compared to banks in such a model. Actually, EU headquartered banks might even, please allow me to say this, be left with low-margin business, while foreign banks are much more able to separate business activities and secure profitability levels on a global scale. This is amplified by the tendency to further implement international regulations in a way which may be more burdensome for EU-headquartered banks than for banks operating in other jurisdictions. Don't get me wrong, I'm not advocating a general race to the bottom. But the standard shall be higher than in other jurisdictions. Market access rules and developments of internal capabilities within the EU and in the Eurozone need to be aligned on this goal. Otherwise, the way for regulatory arbitrage is paved involuntarily, and the EU financial markets will further lose competitive edge compared to other international markets. If this would happen, Europe might have exported financial exposures, which might even look at first glance like having reduced the risk for another financial crisis dramatically, thus having protected taxpayers' money, as has been stated after the great financial crisis in 2007-2008. However, it will expose the real economy to either risks of accessing international capital and hedging markets, which is vital for an open economic area, which is built on trade and the relative freedom of goods, services, capital, and people, even over and above the EU's borders. It actually shifts the risk from the financial market to the real economy, which then needs to pay higher prices for financial services and establishes potentially even a situation where taxpayers need to support corporates instead of banks in a crisis situation, and where the money then is immediately transferred out of the European Union. So the EU might be even left without a capital market and less money in the end. While those developments seem to be rather drastic and concerning, there is equally strong, from my perspective, a lot of potential to deal with this situation and develop new solutions in the years to come. Why is that the case? The European Union is one of the biggest economic blocs on the globe still, even after Brexit. The real economy is comparatively rather strong overall, and there is a lot of demand for financial services in general, and especially for asset management solutions within the European Union. In total, from my perspective, the EU is rather cash-rich, which is not really an economic term, I know, but still, there are banks who have capabilities to provide comprehensive set of financial services within the EU and outbound as well. The EU has long-standing experience in generating benefits out of decentralized federal structures compared to more centralized models across the globe. This means that solutions can be found for establishing an integrated capital market within the Eurozone and the EU going forward, which will definitely, and this is, I think, the challenging bit, look different to today's model, and it will even look different than the model we had maybe 20 years ago. Thereby building structures which might even evolve as blueprints for other parts of the world, and where cross-border cooperation and federal or decentralized models need to be implemented instead of outright power-based ways of cooperation. To conclude my speech, what needs to be done to look into the future with confidence in the financial sector? 1. Financial policy should recognize, maybe more than in the last years, that pure risk reduction on official balance sheet level will not be the only or the right goal in particular, but that balancing financial market capabilities with real economy's relative strength might be the key for the EU to evolve going forward. 2. While staying rather open to international financial markets, as those might generate benefits, a level playing field needs to be established for EU-headquartered banks compared to players operating out of other jurisdictions in so-called third countries. That means the regulation of market access might need to be reviewed, which actually is nothing to be defensive about. Jurisdictions like the United States, China, Japan, or even the UK have considered much more in those terms since the financial crisis than the rest of the European Union. 3. Finalize the Capital Markets Union to establish a real single market without shortcutting by just communitizing legacy issues in national economies. Both cleaning up and integrating will demand a lot from all members and stakeholders alike. But it's necessary to harmonize rules and regulations further to allow corporates and retail customers to access financial services and establish a real market for investments too within the European Union. And lastly, there should be a review of the regulatory initiatives of the last 10 years on a holistic level, not on a technical level, to keep measures which directly reduced either the likelihood of sparking another financial crisis or increased necessary transparency while balancing with operational burdens of financial players headquartered in the EU 27. It still sounds easy, but it will be a quite tough program, and it will need the support of all market players and stakeholders alike in the European Union. But what makes me confident is that the European Union has managed some of those challenges in other areas already, and where, if not in the European Union, could there be a solution for this, and who else could be able to drive this? And to be sure, this is a long-haul journey. Therefore, let me conclude with a citation. It's about trains. One thing about trains, it doesn't matter really where they are going. What matters is deciding to get on. So I beg all of you to get on this journey in the European Union for our integrated financial markets. Thank you very much.